Hello and welcome back. Are you an S-Corporation shareholder or single owner? And are you curious about what you should be paying yourself, how you should be paying yourself in your own company? I'm Jay Fagan with the Maddox Group, and for nearly 20 years, I've been helping small business owners just like yourselves navigate these and all the tough questions around running their business in a compliant, successful, and growth-oriented way. So let's get stuck in. As an S-Corporation shareholder, you're supposed to pay yourself a reasonable compensation. And unfortunately, there's a lot of myths and legends and just misinformation out there about unreasonable compensation. So let's talk a little bit about what that is and how to avoid it. Fact versus fiction. It is pure fiction to pay yourself what's described as the industry rule. There is no rule. It's called the industry rule. It exists in the social sphere, but it doesn't actually exist in real life. And in this particular situation, we're talking about paying yourself wages as a percentage of your sales based on some made-up industry standards. It's not real. Additionally, we hear the 50-50 rule or the 60-40 rule, where you pay yourself a distribution, 50% distribution or 60% distribution, and then 50% or 40% a salary or wage. Also made up, not real. And then there's an alleged safe harbor rule where you can set your wages at the maximum Social Security annual wage limit, and then you'd be compliant and everything would be safe. And again, not real, pure fiction. So how much should you pay yourself? What is reasonable compensation? In the IRS code, it tells us pretty clearly that reasonable compensation is the value that would ordinarily be paid for like services by like businesses under like circumstances. In simplifying that a bit, we're saying that if you were going to pay somebody to do your job in your company, in your industry, what would you pay them? Also known as the fair market standard. So, how much compensation would be paid for this position if a non-owner in an arm's length negotiated employment relationship was paid at a similar type company? The idea here is that the replacement cost of an owner or a key manager of the business should be dictated by the experience in industry and the market. If you were going to pay somebody to do your job, what would you pay them? We talk about this under replacement value and fair market value. These are some of the pure facts, really the two guiding principles of reasonable compensation. If God forbid something were to happen to you tomorrow in your company and the company needed to replace you, you were incapacitated, you passed away, you were unable to do the work, and they had to replace you, what would they pay someone as an employee to replace you? That's the replacement value. And the fair market value ties right into that. It's hand in glove. Should you leave the company and go work somewhere else, or sell the company and go work for another company doing essentially the same or similar job, what would you get paid? What would be the market rate? Both of those are related to the market. And so to a certain extent, this is where we derive the industry rule, is we're looking at what similar industries in the market would pay for similar work. But it's really defined about the value of the market, not some made-up number that kind of sort of relies on an industry standard. And lastly, and this is very important when it comes to defending or justifying your decisions, the many hats rule. Now, while the IRS is nearly undefeated, it's 25, 29, and 1, depending on the cases and the time frame you talk about, but at least since 2000, the IRS at the tax court has won time and time again on this issue. So the law is pretty well established, but one of the things that the court has confirmed is the many hats rule for small business owners, in particular S-Corporation owners that are the single owner or the vast majority owner of the business. They wear many hats. They're doing many roles in the business, from administrative to marketing to sales to the nuts and bolts of the service or widget that you provide. And not all those jobs are paid equally in the market. So when you're considering reasonable compensation, consider the many hats that you wear. Factor the percentage of time you spend in each of those roles, the skills, talents, and experience necessary to complete those roles into your compensation structure. What are some of the advantages to prudent compensation planning? See, S corporations, they have wages that they pay to their shareholder owners and officers and to their regular employees. They have distributions that they pay to their shareholder owners, and they have the net profits, ideally at the end of the year, that are taxed. So wages are subject to income tax and payroll taxes, your Social Security and Medicare taxes. Distributions, those are potentially not taxed because the profit that created that distribution pool in the company has already been taxed for ordinary income rates. Net profits are taxed for income. They're not taxed for payroll taxes. So to the extent that you have capital basis in your S corporation, to the extent that you have what that is essentially is accumulated profits that have already been taxed, distributions are not taxed. However, the caveat to that is you must pay wages first before you take any distributions. So if there is an accumulated net profit in the business and you subsequently take money out of that business, you must take it first as a wage, and then whatever is in excess of that reasonable salary, you can take as a tax-free distribution. Because again, you've already taxed it. So when we're talking about tax planning for compensation, we don't really want to just focus on the IRS regulations. It's important to be compliant. It's important to run a morally, ethically, and legally sound business. I'm not disagreeing with that at all. In fact, that's really core tenet to our operations. Rule number 1, we follow the law. Rule number 2, when we're bought, we stay bought. We are loyal to our clients and we're looking out for their best interest. I don't work for the IRS, I work for you. And so when I'm talking about reasonable compensation, I'm thinking not only about the compliance side, but what is the biggest benefit to you? And in particular, for S corporations, we're talking about retirement contributions, qualified business income deduction, and payroll taxes. Now, you often hear about the payroll tax side of this equation. Pay yourself a salary, you only have to pay payroll taxes on the salary, and all the profit that you make above and beyond that, you just have to pay income taxes, not payroll taxes. That is the allure of an S corporation. The caveat to that is in S corporations, your retirement contribution, the calculation to get your tax deductible retirement contribution is limited to that reasonable compensation. So, for example, if you make $200,000 and you only pay yourself $50,000 of a salary, you're saving a substantial amount of money on payroll taxes, but you're leaving a lot of money on the table for pre-tax retirement deductions. Further, qualified business income deduction. If, for example, in that same scenario, you paid yourself $200,000 and you were a sole proprietor, all of that $200,000 would be subject to the qualified business income deduction, which is up to 20% of that business profit simply for making money. However, when you're an S corporation, we have to pull the salary out of that calculation. And so, for example, in this scenario where you were paying yourself $50,000 because you wanted to save on payroll taxes, you now lost 20% of $50,000 for your QBI deduction. So there's a balance here between not only what is replacement value, fair market value, reasonable, ordinary, and necessary. If you've watched our videos, you know about our good friend Ron. We want to thread the needle here to make sure we have a good balance on the compliance side, but we're also accounting for the benefits and pitfalls of payroll tax savings, QBI deduction, retirement contributions, and other potential challenges that come up with an S-Corp. It's why making the S-Corp election should not be taken lightly and should not be, in my opinion, and just mathematically, statistically correct here, shouldn't be taken by small businesses that aren't generating a substantial profit. So let's reiterate the statutes and the compliance, some guides to IRS and tax court requirements. Again, distributions and other payments by an S corporation to corporate officers must be treated as wages first, to the extent the amounts are reasonable compensation. That's right in the instructions for the 1120S, the Form 1120S, which is your S corporation income tax return. Plain and simple, unequivocal. And this has been upheld time and time and time again by the service and by the tax court. And it's something that the IRS is in particular starting to pay much more attention to and looking to make some changes around attestation by the taxpayer about this reasonable compensation. When you receive your S-Corp election, you filed your 2553, you've been elected as an S-Corp, the IRS has accepted that election, they have right in the letter, the CP 261 letter, which is an attestation that you're making, that you will determine a reasonable salary for your shareholder employees for those services rendered, that those payments will be provided as wages and are subject to employment taxes. And if you incorrectly characterize those wages as distributions, if you don't calculate a reasonable salary, a reasonable compensation, the IRS may recharacterize those distributions as salary and charge you the payroll taxes that you would have had to pay originally, as well as levy fines and penalties for underpayment and mischaracterization. So it's very important to remain compliant, not only from a business operation, as we've said, but from simply the law, the letter of the law, and the attestations you're making when you take on that S-Corp election. The tax court has put out 9 guiding factors. The first 3 are the most important: training and experience, duties and responsibilities, time and effort. Those 3 again go to the many hats theorem, the standard we've been talking about, where you have multiple roles in a business. And for example, if you're a licensed, tax professional, CPA, enrolled agent, tax attorney, and the company's bringing in, a few $100,000 a year or more, and you're paying yourself $25,000, but a junior CPA starting out in a partner track situation might be earning $120,000, $130,000 in the market, that's not reasonable compensation. Similarly, we see this in the construction industry, where a supervisor, general manager, president of the company would be making a substantial 6-figure income. However, in their own S-Corp, they try to pay themselves as little as possible. The IRS and the court has said, your training, your experience, your subject matter expertise, the responsibilities you have, whether they're technical, whether they're physical, substantial legal liabilities, they weigh in on what that reasonable compensation calculation should be. And the same thing for time and effort. Particularly here in California, where we have prevailing wage jobs. If you're a plumbing contractor, and the prevailing wage for plumbing contractors might be over $75 an hour on a California prevailing wage job, and you're trying to get away with paying yourself $15 an hour, you're probably going to find yourself in a bit of trouble there. And again, you're setting yourself up for some failure on the business side when you're not able to take the best advantage of some of those deductions that are out there. The court has also looked at dividend history. Has the company paid out dividends historically? What are the payments, the employment structure it has for non-shareholder employees? Timing and the manner of paying bonuses out to key employees. They look at comparable business salaries for similar services. That's where that fair market value calculation comes into play. And they have considered compensation agreements, but there are gremlins there. If you're making a compensation agreement with yourself as the sole owner or primary owner of the corporation, that is not at arm's length. That is not a fair market negotiation. And it has been struck down time and time again by the court. So when you think about compensation agreements, look to have your business attorney involved, some HR support involved, get some arm's length objective analysis of that compensation agreement should you choose to rely on one. And use of formulas to determine the compensation. Again, that goes back somewhat to the many hats rule, that you have different percentages of time, different roles in the company. So how do we implement this? What are some practical tips here? We want to evaluate your compensation impacts on tax planning before you elect the S-Corp status, if at all possible. If you're already an S-Corporation, we may look to dissolve that corporation or switch back to perhaps a C corporation, or if you're an LLC, maybe again make a change in status away from S corporation tax treatment. You can elect to revoke the election if you so choose. You want to look at annual salary surveys. Across the country, employers and employees all over America have their compensation reviewed annually. You should do the same. Take a look at your salary across the market spectrum, look at what raises and bonus structures are like, and get a good report out there to justify your decision. Now, we recommend a couple of sources for these reports. In particular, if you're in a profession that has professional standards, for example, in the mental health world, psychiatrists, psychologists, their professional organizations put out compensation surveys, if not annually, fairly frequently, and that's great data to rely upon. We also encourage you to, if you're not already with our preferred payroll partner, which is Gusto, they now have a new S Corporation offering where they provide a salary survey, compensation survey as part of their S Corporation packages. There is also the partner we work with, RC Reports, to do these reasonable compensation reports for small business S Corporation owners who are needing that subject matter expertise. And RC Reports is one of the best in the industry. And so you have a variety of options out there. The key thing here is make sure it's objective, make sure it reflects all the roles that you are responsible for. And it's something that you can comfortably, justifiably sustain, not only, again, for compliance purposes, but also for just good business purposes to maximize your profitability and your overall business operations. As always, consider the balance here, your payroll tax savings against possible reductions to your retirement planning deductions and changes to your qualified business income deductions, as well as other impacts of the S Corporation. And if you would like to walk through a reasonable compensation analysis with us, consider the impacts on your overall business operations and what is the best choice for your current S Corporation, or if you're considering an S Corporation, as always, don't hesitate to reach out. We are happily accepting wonderful new qualified clients to the Maddox Group, people that we can provide a great value to, have a great relationship with, helping your business grow, helping see you achieve your goals and objectives. As always, thank you so much for investing your time with me today. Stay tuned for our future videos as we're going to talk about more business tax deductions. We're going to talk about what is taxable income, how to plan for estimated taxes, and some of the additional pitfalls and benefits of S Corporation treatment, as well as many more topics throughout the coming year. I'm Jay Fagan with the Maddox Group. Thank you again. Stay tuned. Allons-y.